exciting to be able to be back out traveling, I'm sure, talking to clients, talking about future deal proposals. Are the valuations right when you're here on the road?
Valuations are rich, which means that there is very little room for error right now, which means it's a great time for people like us that have a 40-year pedigree in this marketplace, not just in the US, but in terms of investing in private markets, backing founders in the middle market space, understanding what is it that they need to make their business grow, and being typically the first provider of institutional capital that propels them from being a mid-sized business to being a real brand. You know, I'll tell you a little story, right? In the late 80s, early 90s, we invested in Gucci. Gucci today is, we don't need to explain what Gucci is. At that point in time, it was a founder-led mid-sized business. That's what we specialize in, right? And having that DNA ingrained in us for over 40 years means that in this market where valuations, go back to your earlier question, Caroline, are really tight and room for error is minimal, if not non-existent, we can win.
So, well, valuations are tight, but the competition is tight as well. I mean, it's a much different environment than, you know, back when the Gucci deal was done. I mean, it's just so many new players in this. So how do you stand out in that environment?
I think there actually we have a bit of a winning hand, and I'll tell you why. Because we have a history of partnering up with founders. Ultimately, when you are operating in the private markets, the seller, the management team decides who to pick, right? Who they want to partner up with for the next 5 years. It's not just a share sale that'll last for 5 minutes or 5 days. It's a 5-year journey, sometimes longer. And for them to make that decision, they look for past precedent, they look for referrals, they want to understand what your DNA is, what your cultural values are, and we have 40 years of evidence to back that up, right? And that really gives us a bit of a differentiating competitive edge.
Of course, you talk about Gucci, European giant, but you talk about yourself being a man of many homes. You, of course, have business within India and the Middle East. Where are the opportunities coming from most at the moment? Where do you feel in your sweet spot geographically has the most to offer?
You know what, Caroline? It's actually been pretty consistent over the last couple of years for us. It's roughly 40% in the US, which is still our biggest market, a little less than that in Europe, and then the rest, about 25 odd percent, is really between the Middle East and Asia. India, China, Southeast Asia. Those have been growth markets for us, but they are still smaller.
Can I just follow up there with China? Have you felt resolutely there's still the place to invest when the rules, the regulations do seem to change relatively swiftly?
In areas where there is a secular tailwind, absolutely yes. So are we going to be rushing to invest in a Chinese property developer? Probably not. But there are certain secular tailwinds to the Chinese economy led by healthcare, technology enablement, etc., that they are very focused on domestically for their own agenda, that we are more than willing to back, and there is value to be created over there in a sustainable manner.
With regards to some of the other nations that you mentioned and the regulatory and political environments in those countries, do you see the challenges there to maybe be a little bit more navigatable?
Look, nothing is to be taken for granted, right? You always have to do your diligence, and it starts top down as well as goes bottom up. Now, are there pockets of the world where we feel more comfortable with the institutional, safety net, if you will, that provides risk mitigation? Absolutely. United States, which is our biggest market, as I said earlier, is one. Western Europe is another. In some of the emerging parts of the world, you have to be a little bit more careful, but most importantly, you have to have boots on the ground, which is why it took us that long to enter the market in Asia. It's only been 3-4 years for us in there, because we wanted to do that with physical people on the ground, with the connectivity, the knowledge, the relationship, the experience, everything that goes towards making a successful asset management business.
Rishi, when you're looking at alternative investments and when you're looking over a longer time frame, how much does actually Federal Reserve monetary policy, global monetary policy, matter in the here and now?
Where it comes into play is obviously in terms of defining effectively the cost of capital that you're going to have to meet or exceed in terms of delivering expected returns to your ultimate asset owners or investors. And the current ultra-loose monetary policy has driven valuations higher and removed the margin for error, as we were talking about earlier. But over a 5-year horizon, Caroline, we are betting much more on fundamental value creation in a sustainable sense rather than relying on the direction of interest rates alone, right? Think of it as betting on the credit of the company rather than on the duration of the interest rates underpinning it.
We've heard that from a lot of other CEOs as well. This idea here that the fundamental picture, the fundamental analysis is, for lack of a better phrase, back in vogue, or at least it's much more necessary in this environment than maybe what it would have been a couple of years ago.
That may be true for some people. That was never really a consideration for us. We have always focused on fundamental analysis. We don't really anticipate or build into our equation any ability to gaze into the crystal ball and predict the direction of interest rates over long periods of time. We are saying, something very simple. What is the position of the company in the segment or the sector it operates in? What value can we bring to the table as responsible owners of that business over a 3, 5, 7-year horizon? And what can that translate into? As long as we can grow earnings, returns will be there.
Are you thinking of exit strategies when some of the companies you've been in for a while, some of the companies that you're taking on, are you thinking, yeah, this would be a great M&A opportunity? I see this company remaining independent, going through an IPO. Does that matter to you?
We always give ourselves multiple levers for both value enhancement as well as exit, right? We are obviously in the business of investing for creation of sustainable value, but that sustainable value that we create has to be monetized so that we can deliver returns to our ultimate investors. And so taking companies public is very much part of the equation. We've got a long history. Gucci was a big IPO, in fact, back in 1995. I'm dating myself a little bit. Yeah. But, strategic sales to other companies in the same space is another lever. Nowadays, the market that is most dominant in terms of exit opportunities is really selling to another private buyer. There's an entire ecosystem that has now taken hold in the private markets, where there is from early stage venture to growth to mid-market buyouts to large cap buyouts, etc. And you are able to create value at every step of the way. We participate in a lot of that value chain.